Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. There's been a real slowdown in consumer spending in recent months. National accounts from the Bureau of Statistics show that while household wealth increased in the first half of 2023 due to higher property prices, deposit accounts shrank by about $6 billion as we saw the first quarterly decline in savings since June 2007. Despite population growth, retail sales growth also missed expectations, giving another indication that Australia is facing a per capita recession. I wanted to find out what this means for investors, whether they're still investing, and whether it changes their approach. And it comes at a time that markets are slipping back, creating potential opportunities for investors, looking both at the ASX and international markets. Of course, this is general information only. You should always seek professional advice before making any investment decision. John Howie recently joined Stake, which is a great supporter of this podcast, as their new Chief Commercial Officer. He comes with a pretty impressive history in the sector, having been the head of index equity for Asia Pacific at investment giant BlackRock and previously holding various roles at Macquarie Bank. John, welcome to Fear and Greed.
Great to be here.
I've got to start with a question about Stake as opposed to BlackRock and Macquarie. BlackRock and Macquarie are two of the giants in the finance world, certainly in Australia. Is it different working for a smaller organisation?
Look, it is, but it's also very similar as well. Not to sort of advertise my previous roles, but look, both of those organisations were very innovative in their own right. And being part of Stake for the last few months, that's been a consistent theme. Obviously, we are trying to improve the investment landscape for Australians. And so I think there's a lot of echoes between some of the work that I did in some of those previous roles, both at BlackRock and Macquarie.
Okay, so the slowdown in consumer spending, what's it mean for investors?
Well, ultimately, what you're seeing, obviously, is that consumers are thinking more carefully about how they spend their money. Look, we all know that interest rates have gone up very rapidly over the past several months. We've seen a lot of data and a lot of news reports about cost of living pressures, transport costs, housing costs, just general inflation, etc. So that really plays across the whole market, and certainly our Stake customers are mindful of that, are thinking about that. But what is interesting from our perspective is that what that means is they're actually focusing more on their investments. When we survey our customers, they are being more careful, more thoughtful, more deliberate in making decisions around trying to improve their own financial futures. They're continuing to invest. They're thinking more broadly about how they invest, how they build portfolios, and ultimately how they secure their financial futures.
That's a good thing, isn't it?
Look, it's a great thing. I think what we're seeing certainly is younger investors who are coming through. Again, this is not new news, but things like property prices, rent, cost of living, etc., is meaning that young people really have some challenges on their hands. And as much as in some cases that might be painful, what it is meaning is that they're actually paying attention to some of those really important longer-term decisions where sometimes those can be ignored or they can be delayed or put off. What we're seeing is certainly when we survey customers is they're front and centre right now, and I think that will pay dividends over the long term.
Okay, so if you're investing now and the market is choppy, to say the least, there no doubt are opportunities out there for investors. How do you find them? How? I mean, I'm just interested. If I'm an investor and I'm thinking about using Stake and putting money into the local market or Wall Street or somewhere like that, how should I think about it? And particularly just with relevance to what's happening right now, given bond yields as they are.
Yeah, look, that's always a very nuanced question, and there's an enormous amount of information out there today. So for investors who are looking to educate themselves, to find out information about what investments they might want to own, all of those questions. So we do a lot of work trying to provide information that's easy to digest and understand. We do see certain trends as investors respond to certain market dynamics. Sort of 12 months ago, you would be familiar with a lot of the activity that was around some of the meme stocks in the US. We saw an enormous amount of activity there. And a lot of that has gone away over the past 6 to 12 months. We've started to see investors now thinking a little bit more about investing locally. So our investments in Australian shares has been accelerating really rapidly. which is great. It's a new product for us. I think it's also partially driven by the current weakness in the Australian dollar, is that investing offshore up until recently has been somewhat more expensive than it was previously because the Aussie dollar was looking relatively weak. And so we saw local investors focusing more locally. That's all very cyclical as things move around. We see investors are pretty smart on average. And we see them generally looking, and on average flows are generally tending towards areas of the market where there's greater value. And you raised that really interesting one at the moment, is fixed income is a really interesting area, and we're starting to see a lot more interest for investors who are looking to generate stable and lower risk forms of income through things like bond ETFs, etc.
Stay with me, John. We'll be back in a minute. I'm talking to John Howie, Chief Commercial Officer at Stake. So actually, I'll get on to ETFs in a moment, but just lots of people think about equities as an investment. But do you think people are more broadly becoming aware of other asset classes, bonds being the big one, but all sorts of alternative asset classes as well?
Look, so people are certainly becoming much more aware of bonds in particular. And what's interesting is that the usage or the investment in asset classes like fixed income in Australia has generally been a bit lower than other parts of the world. There's a few factors behind that, partially driven by the popularity of property in Australia. Tax policies like negative gearing and all of those kind of things has meant property's been very popular. But certainly with interest rates where they are now, that's making fixed income type investments way more interesting for investors. You can get quite comfortably, you can get 5% yields on bond investments and fixed income ETFs, etc. Other alternative asset classes, we haven't seen an enormous amount of interest in that space. One of the alternative asset classes that's easy to buy on exchanges, real estate investment trusts, or REITs as they're known. The price and the performance of REITs certainly over the last few months has been somewhat challenged because REITs obviously are sensitive to interest rates, and so the performance of those assets hasn't been amazing. But we are certainly seeing investors looking further afield than just equities.
Okay, so let's talk about ETFs actually, but I mean bonds is a good way into it. A bond ETF is a fairly, nothing is risk-free, but relative to just putting your money into one bond, it's not a bad way of getting involved.
That's sort of the fundamental benefit of ETFs, is they're generally diversified exposures to an asset class rather than just a single security, exactly as you say. So in the same way that equities ETFs, for example, track the ASX 200, so the ETF will own 200 underlying equities and give you a diversified exposure to Aussie equities, bond ETFs effectively do the same thing. What's interesting about the bond market is in many cases there are far more bonds issued in the market than there are equities. And so in many cases, bond ETFs can have, in some cases, thousands of underlying exposures. And so they really do give investors a very broad exposure to fixed income assets.
And you can get exposure to along the risk spectrum within bond ETFs. So obviously a government bond is rated higher than BHP, which is rated higher than a much smaller company.
That's exactly right. So there's, in terms of the credit risk of bonds, there's, very broadly, there's kind of two versions. There's government bonds, which, as you say, in inverted commas, are a risk-free asset or a very low-risk asset in terms of default. And then there are corporate bonds, which are issued by companies like BHP and the banks, etc. And depending on the issuer, they will generally have either a little bit more credit risk or maybe a lot more credit risk than government bonds. But the beauty is that there are, I don't know the exact number, but there's definitely dozens of bond ETFs available on the ASX now, and there's probably thousands of bond ETFs available in the US. Obviously, Stake provides access to both Australian and US markets, and so investors really have a huge range of choice when looking at things like bond ETFs.
Okay. Now, you've been with Stake for not that long, is that right?
Yeah,
John?
4-ish months now, so still pretty new in the chair.
I think your gig is to grow it. I'm guessing your gig is to grow it, given you're Chief Commercial Officer at Stake. It's a pretty competitive spot to be, though, isn't it?
Look, it is. So there's a couple of things. I think we really perceive the ability to serve investors in Australia better than they've been served in the past by some of the incumbents. And I think what you've seen again over the last few months is some of the incumbents have started to ultimately react to some of the improvements that we've made, which look is great for investors and it's great for competition. But I think it's evidence that we've done a really good job in providing a really compelling service, and we've managed to become the third largest digital broker in the market now, which I think is evidence again that we've got a strong proposition and we're continuing to see customer growth. And look, I think you'll see the natural evolution of the market. There really was a huge pickup in investor activity around the COVID pandemic. People obviously stuck at home, and we saw across the board new customer sign-ups accelerated strongly, trading activity accelerated strongly. That slowed down a little bit, and so you'll probably continue to see rationalisation in the industry, but we feel like we're really strongly positioned to be a market leader going forward.
John, thank you for talking to Fear and Greed.
Absolute pleasure.
That was John Howie, Chief Commercial Officer at Stake, a great supporter of this podcast. This is the Fear and Greed business interview. Remember, this information is general in nature and you should always seek professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Have a great day.